Joining me now for a broader look at this afternoon's market performance is Lwazi Matakane from Nedbank Private Wealth. Lwazi, thanks so much for your time this afternoon. Now, the past week really has been crazy, Lwazi. Markets just yo-yoing. We've touched record lows. We've been at high highs. And it's just tough to gauge where markets are and what markets are going to do. And one thing we can definitely be sure about is that we are in an environment of volatility. And with that in play, how are you positioning yourself in the current environment?
Thanks, Ndawaleng, and good afternoon to your viewers. So, look, I mean, we've seen this whole tariff story playing out. It's haphazard. We are seeing, retaliatory tariffs from other countries. The market is really spooked. We saw the VIX last night jump at almost 30%, 29 odd percent. It's sitting around about 40. I know when it hits around 50, the market gets spooked and we start seeing, structural decline or tangible decline within capital markets. So, yeah, if you have to position yourself in a time like this, it's not time. Well, it's a time to be cautious, not a time to be catching a falling knife as per se. So most people would love to buy the dip every single time it takes place. There is opportunity in that you're going to find good companies selling at much lower prices than they were a couple of weeks ago or a couple of months ago. If you're looking at our own industry, it's much cheaper than it was around December or beginning of the year. So I wouldn't, for myself personally, I would keep dry powder, keep cash, and have enough money to keep buying and cost average lower as the market falls.
And, we have this tariff story really fueling markets action. And while we saw a pause in tariffs, the US and China are still at it. How concerned are you about this becoming a fully fledged trade war, or are we at a point where it actually is a trade war?
Look, we should be concerned because remember that China has got a huge manufacturing base, and the manufacturing capacity there is quite large. And if we start seeing supply chain disruptions as a result of that taking place because of the trade war, then there's a global inflationary aspect to it. And when you start looking at central banks and the reasons why they actually now are changing tax on the policy rate front, a recessionary outcome is probably one of the things that it's top of mind. So what we do not want to see is a continuation of volatility and indecisiveness taking place within the markets, because markets don't like negative news for too long. So if that permeates for too long in the markets, we are going to start seeing the markets front run a bear market. We've seen corrections in the US already taking place. We haven't seen these markets get into bear territory yet, but they probably will start going towards that if this negative perception about markets and global economy and the US and China continue to permeate in the information space.
And very close to bear territory. We also have U.S. earnings season kicking off today. Big banks out with Q1 earnings. I think we've got JP Morgan as well as Wells Fargo out with numbers today. What are your expectations on that front? I can imagine that, a number of analysts will be looking at outlooks and forecasts, considering that we now have, the tariffs in play and we know the kind of scope and the tariffs we are dealing with.
No, sure. And yesterday we had that inflation number, which didn't look too bad, but the market obviously overlooks that because it's a backward-looking number. And top of mind is the impact of tariffs going forward. So generally what you'd want to look at is how the guidance going forward with respect to provisioning, with respect to credit lending conditions. Are we seeing a tightening in credit lending in the US? Are we seeing these banks provision more for a consumer that looks a bit downbeat, or a consumer that is not spending as much? We should see conspicuous spending come down as a result of the sentiment on the ground and what's taking place. So, I mean, you would expect somewhat that the earnings looking backwards wouldn't be so bad.
Yeah.
But the forward guidance around, call it margins, call it provisioning, call it credit lending, the fee space within investment banking, because companies are not going to invest in an environment that is highly risk off as a result of what's happening or transpiring within trade policy. So you might see the CIB space also not looking great with guidance around fees and M&A activity. So there's a lot of things that you want to look out for. but I reckon the guidance might just be negative to the downside with respect to banking earnings going into the future.
And talking about M&A activity, a deal that I'm surprised went through is the Prada Versace deal. They'll be combining the Italian luxury brands that set it up rather to compete with the likes of Kering and LVMH. What have you made of the move and the timing of the move? Yes, we are seeing a slight recovery in the luxury sector, but I guess not a great time considering what the macro picture looks like and where we're going.
So remember, in these business cycles, companies tend to consolidate once a cycle is going lower or going down, and obviously going into expansion, then you start seeing more activity as the cycle, kind of peaks or start moving higher. So what we are seeing is a bit of consolidation in the market. I mean, both those brands are highly desired brands, and if they consolidate their respective market shares, they can compete better versus the Kerings versus the LVMHs. So it's something that you would expect in accordance to the macro cycle. I don't think there's anything beyond just taking the opportunity to consolidate and strengthen, their respective positions within the luxury goods space.
All right, let's hit pause on the conversation. Before we get to your stock pick, let's reflect on some counters that have found favor with your industry peers.
So I'm attracted to Boxer because I think we're in an environment where you're going to find companies that are struggling to grow in general. The economy is going to struggle to grow a little bit. Inflation is likely to come back, or at least it's not going away with tariffs and all these other concerns and the rand blowing out. And so you want something that's defensive but can still grow, and that's Boxer. The food retailers can pass on price increases. People have to eat no matter what inflation is. They'll give up another fancy leather jacket or a pair of Italian shoes, but they can't give up eating.
Yeah.
So the retailers are defensive in that sense, and they can pass on inflation, so they give you a bit of a hedge, and they can still grow because Boxer's got a lovely rollout strategy of a lot of stores. They haven't even nearly finished their rollout in terms of their plan over the next 5 years. So it's a nice little upside growth opportunity, and it's a defensive bias to it as well. So I like it.
You've got Costco and Walmart here who are making an incredible effort to face the challenges. And Walmart gets in a lot of goods from China, but still, they're a kind of business that will tailor themselves for the consumer to make sure that they maintain their market share. I love Costco as well. Two of the very similar businesses.
So both Grant and David playing in the retail space with Boxer, Walmart and Costco. Just your analysis on those picks, Lwazi?
No, sure. I mean, Boxer, obviously, we know is a lower LSM retailer. It's got plans, obviously, to increase store capacity or stores around the country. There's a lot of white spaces that they can go into. If you look at some of these malls or urban shopping centers, which are vacant as a result of what's been happening since 2020, and these shops are moving out. So there's white space that they can get into. They can start moving into different jurisdictions or regions and get exposure to places that they weren't there before. And again, obviously, the defensive nature of you need to eat food at any cost. Well, at any cost. There's a bit of a less elastic demand to food. So I would pick it in a defensive sense if you want to defend your portfolio. With respect to Costco and Walmart in the US, preference would probably be towards a Costco. They've really worked around the omnichannel model that they have. Walmart is still investing on the omnichannel model, trying to get obviously e-commerce up and running and being a big part of how their sales distribution, where Costco has actually got that doing quite well for them. So they've got footfall within their own shops. They've got a lot of orders through the e-commerce perspective or the side, and they're doing quite well within the US with respect to comparable sales, up in the upper single digits towards the lower double digit numbers, both in America and in Canada. And you look at the international comparable sales numbers, they're also doing quite well. So I'd have preference for Costco if I had to choose between Costco and Walmart. But I do like Boxer as a defensive as well in the local space.
All right, and where are you finding opportunity in this volatile environment? Are you preferring to, buy into the dip, or are you sitting on your hands and playing it safe?
Look, I mean, sitting on your hands is also a decision. You want to have some dry powder. These markets are going to be volatile. We are going to see these gappings of markets going down as a result of headlines, and that's what happens when there's too much volatility within capital markets. And as these markets go lower, you can cost average lower and keep buying good companies that you think will, work well when the cycle turns. So I stick to holding on to cash just for execution purposes. When I do want to get into the market and start executing on a couple of purchases that I see as attractive from a valuation standpoint.
All right, Lwazi, thanks so much for your time and sharing your insights on trade at midday. That was Lwazi Matakane from Nedbank Private Wealth.